Welcome to another episode of Coffee and Conveyancing. I'm here with Mike Mortlock from MCG Quantity Surveyors. How are you, Mike?
Very well, very well. I'm enjoying my coffee and
Good to see.
And the quarantine as well. I should say isolation. I'm not in quarantine.
Isolation, mate, but it looks like you're in your office, so you must have gotten rid of everyone else.
Yeah, no, they're at a safe distance, which is actually a policy I think we'll run with for the distant future as well.
For the next 6 months, yeah. Look, I wanted to get Mike on the show because Mike's, as it says in his name, a quantity surveyor. So he can do all the reports you require if you're an investor for tax. So on that note, Mike, can you tell me a bit better, instead of my summary, as to what you actually do?
Yeah, so there's obviously a few different ways that you can minimize your tax as a property investor. There's things like the property management fees, the repairs and maintenance. Probably the biggest one from a dollar value would be the interest component on your loan. And perhaps second would be tax depreciation. So I'm a quantity surveyor. I've got a Bachelor of Construction Management. There's a certificate somewhere. And essentially what that means is I'm a construction cost estimating specialist. And tax depreciation is essentially an allowance for the wear and tear on the building structure over the life of the property, and that can minimize your taxation. So we're a little bit like valuers. So people might be a little bit more familiar with a valuer. They will go to a property and they would come up with a market value. We sort of do that, but don't include the land. We're only in looking at improvements to the land. So we're coming up with a cost to construct that property. And then depending on the different categories, that depends what depreciation rates we can apply. And it all ends up in a report showing the deductions that you can take off your taxable income each year.
Right. Now, is that report something that I need to know how to read, or I just ship that straight off to the accountant? How do I deal with something like that?
You can have a go. Most of our engineer clients have a red hot go. They'll read disclaimers that I wrote 10 years ago. But no, we have a video of how to read your report. The reason is because it's really prepared for accountants. They're normally the main end user for the report. So it's very technical. They want it broken up and sliced and diced into a million different ways. So there's a couple of key things to look at if you know what you're looking for, and that's what we point out to the video. So you don't actually need to know exactly what's going on. Your accountant would potentially recommend a depreciation schedule. You can chat to someone like me who will assess whether there are any value in a report, getting a report done. And then that just goes off to your accountant and they'll figure out what your tax deductions are based on that.
Well, speaking of which, why then why can't my accountant do that for me?
Well, accountants they're certainly tax specialists, but they're not construction cost estimating specialists. So
and that's the real difference. Okay, so,
yeah.
So you're looking at the materials, what can and can't be claimed.
Yeah, the accountant might know that you've bought, say, a $500,000 investment property, but they won't be able to say, well, of that $500,000 that you spent, 300,000 is attributable to the building structure, and there's $5,000 worth of carpet, etc.
Gotcha. Right. Now, is everything the same? Is it just a base rate? Everything's 10%, or is there something that's a little bit different to something else?
Yeah, so there's two main sort of buckets of depreciation. One is the building structure. So it represents the majority of the value. It's things like the concrete slab, the timber frame, the gyprock, the roof. That's a flat 2.5% deduction if that qualifies. So the property's got to be built after the 16th of September 1987 to qualify for that, or any subsequent renovations. Then there's the plant and equipment items, things like carpets, blinds, oven, cooktop, hot water system, air conditioning, and things like that. So they all have different effective lives that the Commissioner of Taxation brings out each year. So for example, carpet has an effective life of 8 years, and then it depends which method you use of what the depreciation would be. So with carpet, it would be 200 divided by the 8 years gives you the depreciation rate.
Gotcha. And you just operate off receipts or anything like that, or you just know the costs?
It's our job to know the cost. So where someone puts some new assets into a property, we need to use those figures. So yes, we certainly get shoeboxes full of receipts from time to time. But most of the time when people buy a property, they'll engage us straight away. So they haven't done anything to the property. So there's no real construction information. So that's why you need a specialist who can estimate the construction value.
Great. So if I've got a client, they buy an investment property, we then suggest they talk to Mike, because you would then go in, say, congratulations, obviously, on getting a property, but this is how we draw up a schedule, a tax depreciation schedule, if that's what you call it, that goes off the account. They would get you in pretty much straight away and be able to then use that total amount against their taxes, I guess, is how they do it, on their income. Would that be fair to say?
Yeah. Ideally, they would. Certainly, some people wait a little while before engaging us, and you can backclaim 2 financial years worth of deductions, and that might come at a...
Sorry to cut in there. Why would I wait? Why would a client wait? What's the advantage? What's the disadvantage?
There is no advantage. There might be a disadvantage. Let's say if you're planning to do a major renovation, it might actually be better to wait until that's done.
Okay.
Most of the time people wait because I think they aren't aware of the deductions they're able to claim. And we have actually found that 6.7% of our investors wait so long that they actually miss out on some deductions in the past. And the average value of that is 20 grand. So it's pretty significant.
Really?
I mean, that could be $7,000 back in your pocket, for example.
Yeah.
So I would encourage people not to wait.
Yep. Okay. So they buy a property, we finish it, we settle them. It's best to then say, go and talk to Mike straight away.
Yeah, we think so. So the first step is we'll assess whether there are potential deductions in the property.
Mm-hmm.
So it's certainly the case sometimes where we say, look, this property doesn't stack up for these reasons, so we can't in good faith recommend a schedule. If we're charging people money, we need to deliver value, obviously.
Yeah.
But, you know, that's a free conversation, and most of the time there are deductions available in that property that can make that report definitely justified and very beneficial to the owner if they're renting that out for more than a year or so.
Fantastic. So then, mate, are you allowed to say, like, if I'm going to do something to a property, can you tell us what are the good things to claim and what not to claim? Should I be putting in the air conditioner or not putting in the air conditioner? Are there any tips and tricks you could give any investors? Legally, obviously.
Yeah, no, of course. We've got to be by the book here. You've got to think. My job is essentially to minimise the tax revenue of the government. So they're a pretty big enemy to have if you're doing the wrong thing. So
hence why you've got to get Mike on your team.
Yeah, but it's a very good question. If you're doing a renovation, then there are some things that you can decide to go one way or the other that would make a big difference to your deduction. So if you're spending $100,000 on a reno, then you're only going to be able to claim $100,000 worth of deductions, right? But the worst case is that you're waiting 40 years to get all of those deductions back.
Right.
Now, to give you an idea, if you put carpet in a property, so up until 1st of July, the depreciation rate was 20%. So if you put carpet in a property, you get a 20% deduction year on year. If you put tiles in, you're getting a 2.5% deduction year on year.
Okay.
So 2.5 times or 2.5% of the value of the tiles, or 10% of the value of the carpet. That's where we might say, yes, you might prefer tiles or they might look better, but if you're sort of either way, you'd be much better off to do carpet because it's a plant and equipment item, same as floating timber floors or vinyl, whereas tile is considered part of the building structure. So it has a 40-year effective life as opposed to carpet, which is now an 8-year effective life.
Right. Okay. So having those conversations with you before doing a reno would be quite beneficial.
Yeah, I mean, I'm available to have these conversations at barbecues. It's surprising how few people take me up on that.
I've heard over alcohol as well is the rumour too, mate. Is that right?
Oh, mate, you've got to let your hair down. I mean, I'm wearing mine up today, but yeah, you can't take yourself too seriously.
No, that's true. But tell us some good news stories. Are you allowed to share with that? Obviously, giving names. Have you got some stories of where somebody's gotten a report and it's benefited them a certain amount of money?
Yeah, absolutely. In fact, I crunched a couple of numbers before jumping on with you, and we've for our residential clients, we've actually found over $1.46 billion worth of total deductions for them.
Wow.
And at let's say a 37% marginal rate, that's $540 million back in investors' pockets. So I think that's pretty good news.
That is brilliant. And you're obviously not claiming a percentage of that.
No, no, wouldn't that be lovely? I mean, there are often times where we will do a commercial report and we think, if we just sort of got 2% of that deductions, that's probably us for the year.
Yeah, done and dusted.
We did one commercial office that had a total depreciation of 200 million. So yeah, that would have been a nice one to get a percentage on. But no, we're really just quite based on the amount of work it is for us. So we've actually done $40 million car park for the cost of about, say, 3 houses, just because there's so little in it. Yes.
Yeah. Wow. So on the topic of costs, can I ask a ballpark figure as to what someone could estimate for a normal residential property that they want to get looked at?
Yeah. I guess fairly standard across the board for a full service firm. And what I mean by that is someone that does an inspection of the property. And I wouldn't recommend people get a depreciation schedule from companies that are saying that they can do it online. It's normally around the $600 or $700 mark.
Okay.
So I think probably around about 700 plus GST is about the top of the range. And then you get around the sort of 500 or 600 plus GST mark as well.
On that. That's good. And I don't know if we can answer tax questions, but I'd be guessing that would be tax deductible anyway.
It is, yes. No, I'm not an accountant, but I know enough to know that is tax deductible. It's considered the same as paying your accountant to do your tax return. It's part of tax preparation. Gotcha. So yes, it's fully tax deductible.
Oh, that's good. That's good. Well, mate, is there anything else that you think you should share with our investors that I might have missed, questioning wise?
I think so. Like it's important for people to just try and understand whether they would qualify or not, because there's a lot of misinformation out there to say, oh, look, I bought an older property, so there's no deductions in it. So I'll give you 3 triggers if I can.
Yeah.
If you buy a brand new property, you need a depreciation schedule. If you buy a property built after 1987, specifically the 16th of September 87, it's automatically going to be worthwhile because the building structure qualifies. So you're getting 2.5% of that value. Yes. And even if it was only 100 grand to build in 1990, you're getting $2,500 worth of deduction. So that's significant.
Yes. Yeah.
The last trigger is when you buy a property that's built pre-1987. So it might have been built in the 60s. But it's been renovated or there's been an addition done by the previous owner, and that covers most older properties. So if it was built in the 60s or 70s, yes, it might have a mission brown or apple green bench top, but a lot of those places have been renovated and updated. And if you know that there's been at least $40,000 or $50,000 worth of renos, which probably doesn't go very far in a bathroom and kitchen reno, then that's the point where it's likely that there are worthwhile deductions in that as well. So new after 87, if it's pre-87, has there been 40 or 50K of reno? And really that's where you need a depreciation schedule, but I'm always happy to provide free advice.
Fantastic. So on that topic then, what's the best way to get in contact with you?
I'm pretty easy to find, like that or not. I'm all over LinkedIn, Facebook, all the usual socials, Instagram, but it's mostly weird stuff there. But our website is MCG, as in the cricket ground, MCG QS for Quantity Surveyors. So you can go to mcgqs.com.au.
Fantastic. Mate, and I'll put up all your details on this recording anyway. So if anybody needs anything, they can contact myself. I've got Mike in my phone, so I'll be able to give you all the details. But we'll also have it at the bottom of the screen, any of the recordings. Mate, well, I just want to say thank you so much for giving us your time to explain this to investors. I'm sure we'll have a few investors in the future that will throw your name out. We've already given your name out a few times, and you've looked after those clients brilliantly. So thank you very much for that. And mate, thank you for being part of the another episode of Conveyancing and Coffee.
Pleasure. Good fun. Enjoyed the coffee, enjoyed the chat, and all the best, mate.
Thank you very much, mate. We'll talk again real soon.
Cheers.
See you, buddy. Bye-bye.